Thanks for inviting me. Hello, everyone. My name is Mike Paulenoff, and if you see my screen, that would be me. And my website is mptrader.com. And I have been, let's see, this is, we started in 2003. So this would be my 20th year on this website. And I am the chief, I guess, technician, analyst, bottle washer, everything, all of the above. And just to give you a thumbnail sketch of what the room looks like, uh, it's a diary, and there are lots of updates. If I go back to the first update I did this morning, it seems like all these, today's the 19th. Okay, good morning. All right, so this would be my first update this morning, and I introduce the day. And today I was talking about Tesla and Netflix, their earnings and their reaction to earnings. And then I went into the stock indexes, Nvidia, and I put up my work. And then there are responses and dialogue, ideas, trading ideas. Uh, what I try to do, my expertise is pattern recognition and technical analysis. And my subscribers or the members of MP Trader are also technically oriented, but many have a fundamental background and they want to know, or they want to get an idea of what the technicals are saying, either to overlay on their fundamental work or to provide a basis for understanding the charts. For instance, I did crude oil this afternoon. I've been doing it a lot lately, as you might imagine. And so here's my crude oil chart with my annotations. They tend to be very detailed charts, and we can discuss them in the room. We can discuss why I have my support and resistance levels where they do, what my pattern recognition tells me. And I usually describe what I think is going on in general, and there can be discussion and so forth and so on. And this happens all day long. Today happened to be a crazy day, as everyone probably realizes. And so, uh, if you're interested in the technicals and you're interested in interacting and exchanging ideas and charts and philosophies, well, maybe you should log on to mptrader.com and see what we're doing. Okay, so that's my introduction, but you're here to ask about names that you're interested in. Let me just give you a thumbnail of what I'm interested in. Okay, so uh, let's see, hang on. Okay, so do you see this chart? No, new share. That would be better if I did it this way. Okay, there we go. All right, so what you should be seeing is my very long-term 2004 to present crude oil chart. And so, I've been doing this for like 4 decades, and I've seen bull markets, bear markets, everything in between. I've been on the right side, the wrong side, every other side of markets. I've been whipped around psychologically, but my whole career is a learning curve. And the minute anyone gets too cocky in this business, well, the market has a way of slamming you in the face with humble pie. And if you haven't experienced that yet, consider yourself lucky. But when you least expect it, humble pie is coming your way. That much I can guarantee, and there's not much you can guarantee about these markets, but humble pie is one of them. In any event, so you can tell by my annotations that, after July 2008, we had that crazy up move in crude oil to $145. We went into a bear market, and that bear market lasted all the way until 2021. The question is what we're in now, and this seems to be the flip side, both fundamentally, technically, and from a supply demand perspective. This seems to be the opposite. And I guess I should have put deficit supplies, resurgent inflation, Ukraine, and now Israeli wars, and also the green revolution, which is trying to eliminate fossil fuels. And that's certainly a driver of this, let's say, sine curve. So anyway, this is a very long-term picture, and it gives me a basis for either bias, in which case I have to keep reaffirming the bias, and I do that using shorter term charts. So for instance, if we stay with crude oil, by the way, I'm using TradeStation, and I've used it for years, and TradeStation gives me the flexibility to quickly update my charts for no, Carnival Cruise. Well, Carnival Cruise Lines. People are running out of money to take cruises, and the cruise line itself is paying up for oil. So that's why Carnival Cruise looks that way. Hang on, let me try to get my my crude oil chart. I know I have a shorter term crude oil chart. Well, okay. In that case, let me go to the videotape and go to my energy chart package. And all right, let's wait for this to load. In any case, so what I tend to do, I go from a very long-term picture, like I just showed you in 20 years of crude oil, and then work my way backwards or concentrically towards the center, which would be shorter term work. And I overlay and look at each one of those time frames. So I think I know where I'm at in each one of the time frames and how the time frames fit in with my expectational bias for a market. So my expectational bias for crude at the moment, as an example of how my analytical brain works, is that here we have a war premium built in or building in. And today I think it was an example of that war premium starting to ratchet up to another level. And so I don't know how high crude can go, but my 20-year chart tells me that it can go well above 100, like to 130. Now, maybe there are ameliorating reasons why it won't do that. But right now, after this loads, we can take a look at the shorter term work, and today reinforced the longer term picture. And as you can tell, there are lots of charts in here, and a lot of them are, some are natural gas, some are stock charts, and which we can get into. But for the outset of the webinar, if okay, here we go. I think we're almost there. Okay, here we go. So here is my 4-hour candle, or each candle is 4 hours. And this is when we peaked at the end of September at 93.81. This is the December crude oil front month contract. We came flying down 14, 15% in a hurry. But these spike lows that we had in here, each pullback went to a higher low, and now it looks like we're in a new up leg, and here we are trading at 89.5. Looks like we're going to 91 to 93 to me, but that's just based on the short-term move and the way momentum is set up. It looks like everything is in gear to move higher. The $64,000 question for me is, how much war premium is there to go? And the chess pieces on this war premium board could go anywhere, right? I mean, it could be an embargo. There could be there could be a wider war. There could be Iranian participation there, which certainly would ratchet up crude oil, and on and on and on. Now, all I know is that it looks like it's going up to me. The pattern is higher. The near, intermediate, and longer term patterns sort of concentrically support one another. And right now, I know that if it breaks $85, all of a sudden we wake up one morning and it goes from 90 to 85. We're going to find out that it wouldn't be the Strategic Petroleum Reserve that gets it to go down to $5. Probably it's a ceasefire or something along those lines. That would be my perception. Anyway, so that's kind of a thumbnail sketch. And while I'm on the crude oil chart, do we have any questions in the energy sector while I'm in here so I can take a look at it? Let's see. David, are you there? Oh, here we go. Thank you.
Yeah. Yeah.
Sorry, I didn't.
You were looking for the chat?
Yeah, I just opened it. Thanks.
Okay, great.
Okay, so we have SAVA, Dell. So we've been every Monday is 15 weeks. All right, so I did Roberto. I discussed oil, SLB. So while I'm in this sector, why don't I do SLB? Move this over, and let's see if I have a slob chart. Slob. I haven't updated slob in a while, but first, what I'll do is show you my my producer chart, XOP, which will okay. So you can tell by how busy this chart is. The XOP is the oil and gas ETF, right? Exploration ETF. And I haven't updated in a little while because I've been updating individual charts and watching the price of crude. And my latest horses have been Coterra, Oxy, Devon on a bottom on the end of its correction, which we can take a look at if you want. But in general, the reason why I'm showing you this chart is because it is fascinating to me. You had a giant base here between 2019 and the end of 2021. You can make a case inverted head and shoulders, cup and saucer, or sorry, cup and handle, and then the breakout in 2023 and sideways bumping along the breakout level. Classic technical analysis. You don't need Elliott for this. You don't need cycles for this. This is classic stuff. Base, breakout, handle, pullback, whatever you want to call it, launching into a new up leg. And here, now I came up with this target off of this projection off of the bottom, a year and a half ago. I don't know if it's going to get there, but it sure acts, and we sure have the environment to send XOP, and XOP involves a lot of these stocks, right? The Slob is not one of them because it's not an exploration stock. It's more an oil field equipment stock. But anyway, so if this rounded handle kind of pattern is true to form, we're about to break out. And if there's war premium going on here and the market and the crude oil market opens up $3-5 higher, who knows, then XOP is going to rock it. And the components in the XOP, which you can see, or you can look up, some of these might have changed, but they're the ones driving it. And so this is an example of a longer term picture of an ETF that looks very powerful. So now if I go over and look at the XLE, which probably is the more common one. Okay, now XLE looks a little different than XOP. Nonetheless, the dominant trend line going all the way back to, well, October 2020, that's 3 years ago, is intact. Every pullback low has basically been higher than its predecessor. And now XLE looks like it's breaking out. And if I were to extrapolate this, then XLE looks like all of this, and in particular, everything for the last year rather than the last year and a half, looks like a rounded base. Can't be a base up here. It's a rounded shoulder, a rounded bull flag kind of appendage on this big up leg. It looks like you could go a lot higher in XLE, especially if it takes out this 94, 95 area. It looks like it's going, well, let me tell you where I think it's going. So I am a fan of channel analysis, and it's one of the tools I use. And there are various channels you can use here. So the first one would be 97, 98. And then the second channel, and the more likely one in a war theater crude oil kind of setup would be up here near 110, 112. And of course, if it takes out this dominant trend line, which right now would be also be the 200-day moving average, and the 100-day they've just crossed, positively crossed, then 83, 84, $85 would be a place where if it broke, that would be a major warning signal that XLE is exhausted. Okay, so I'm not going to be able to change pages for another 30 seconds or so because this is my backup time. So it's going to back up all these charts, and then I'll be able to change the page, and I'll create an SLB chart for you and take a look at it. And then we'll do some other things like Dell and some of the other questions in the chat. Let's see what else is in the chat. XOM. Okay, we'll do XOM too while I'm in here after this finishes. So let's see. Today was kind of a funky day, and when I looked down the list of names, right? Crude oil was up 2.5%. Exxon was positive, but there's a lot of red ink in here, probably because okay, so it's done. All right. Let's see. XOM. All right. Well, let's do the XOM weekly just for, okay. Wow, look at this. All right, this goes back to, let me widen it out. This goes back to 2002. And when I widen it out, I'll condense it again so you get the full picture. All right, this has turned out to be a super bullish chart. The reason why I say that, at one point, as you can tell, when we were breaking down, Exxon had a pretty big top on it. In fact, Exxon spent between June of 06 and March or so of 2020, what is that, 14 years? in a range, and it broke down into look at that. It broke down into where I had extrapolated based on the measurements from this top where it could go initially. And so it went into that breakdown area around $30. I had looked for 27.80 to 26.20. And that turned out to be back up to truck time. When it was down there, it probably looked frightening. But as it made a double bottom in here remember, this is a weekly chart, as it made a double bottom in here around 30, and then it started to take out some of this resistance at above 35.40, then you knew that at least it was going to test the breakdown point, which is in here. And once it started to consolidate in the breakdown point at 60.62, it took off. Now, it's come a really long way since this low back in the pandemic, at the pandemic low. So it went from 30 to recent highs of 120. Now, for my purposes, as long as it stays above $97, $98, all of this from, let's say, 100 to 120 is a high level digestion period and pattern that we could look at as a bull flag, kind of. It's a digestion pattern of 2 years worth of bullish price action. As long as it stays intact above $98, my expectation, especially under the circumstances, would be a test of 100. I'm 120, and when it gets above 120, I think it goes to 140. Now that would be the target. So, and of course, anybody in Exxon would want to put their trend line in here to see how tight that is. And you know where your risk is, below this pullback that occurred last week. And that would be like 104, 105. So Exxon's trading at 113. You have a 104, 105, risk factor in a normal pullback. If peace breaks out all over the world, then who knows, you could gap down, to $92. But in theory, your stop is at 105 and your upside target is 140 at the moment. Okay, let's go back to the chat. Okay, XOM. Oh, slob. Yeah, let's do slob. Sorry, William. Slob here. Let me see. Where's my slob chart? Where's my 240-minute slob chart? The reason why I use 240 minutes is because I get to see all the squiggles, right? And I like seeing the squiggles because let's just say this, that after 40 years of doing this, it's pretty hard to imagine that I've been doing this for 40 years, but after 40 years of doing this and looking at charts, I can't even tell you how many charts I've looked at. So I've seen patterns on top of patterns on top of patterns. So I consider myself a pattern expert. That is to say that the psychological meaning, the psychological implications from these patterns, for the most part, I've seen. And in that human psychology hasn't changed. I think, if anything, we've gotten more intolerant and stupid in our progressive age, as it were. The pattern, the resolution of these patterns, there aren't all that many resolutions. What the market will do is squiggle and wiggle to confuse us. It will do whatever it can to get the fewest people on board or that is to get the most people out of a market before it does exactly what all the people think it's supposed to do in the first place. But it will, like the crude oil market, went down 15% before it took off again. Most people probably got stopped out. Most people figured that, that was it. Crude oil's cooked and it's done. And that we're going into a recession, and gasoline prices are going to go back to 250, and crude oil is going back to $65, and that's the end of that. And so that 15% move in crude oil killed people. That was in here in slob. So anyway, enough about market psychology, but that's what these charts are all about, market psychology. So if I use my channel work, then the near-term target or parameters for slob is obvious. There's a gap down here that needs to be filled if and when slob rolls over a bit, which is 56, with the stop is at 54.80 or so. But this up leg, this looks like a very bullish pattern to me off of the June 23 low down here at $42 into the high at 62.63. Pull back. Here's where the war breaks out, and that's what we're in, the war up leg now. To the extent slob participates in the war premium theater group of stocks that will benefit from rising crude oil prices, here's where it's going. Here's where my work says is where it could go. 67 to 70, say. And if it takes out the upper channel, usually when it takes out the upper channel, it may look great up here or up here, but chances are it's about to trap you. Now, occasionally that's not a trap. Occasionally there's a reason. Like, for instance, if earnings come out up here, or when, let's say for argument's sake, slob at $66 and earnings come out, I would say that it better knock the cover off the ball and far exceed expectations and have visibility that's even stronger than earnings to get it to take off when it's already met this upper channel boundary zone. And that's what it would take. And even then, you have to be careful that I certainly wouldn't be buying it into bullish news at the top of a channel, because more often than not, it's a trap. And if I was already long, I'd be cognizant of a move above the channel and then a close back below it, because that's possible too when you're up against major shorter term and longer term channels, the upper boundaries of those channels. So anyway, that's slob. It looks pretty good. And of course, we can, you can step back, get a little perspective and say, well, look at this, So all of this behavior, all of this from here all the way to here, that's November of 22, a year ago, to where we are, to where it started to try to take out the prior highs. That was in August, September. And here we are. You can look at this as a digestion period of what came before it, this up leg right here. And you use this and say, okay, well, this is what I see. It could be that you're still in this digestion period, although I think this started a new up leg. We just haven't broken out yet. It may be that slob is going a lot higher, but this is where I think it's going first, and then we have to check all our gauges and oscillators to see whether there's gas, so to speak, in the tank if it's up here. So anyway, that's kind of my thumbnail of slob. Slob reports tomorrow. Okay, well, thanks. Well, this is the story. I think the slob parameters are 56 if it disappoints, or otherwise it sells off. And if it's great, then takes out 63, 62.50, 63. I think you're going to 68.70. All right. We'll do Nvidia in a second. PhD, let me start at the beginning here. What did I miss? SAVA. SAVA is a biotech, Dell. Okay, so let me go over to my webinar charts, and let me, hang on, let's put that over there. Look at this. This is my SPY chart, my hourly SPY chart, and so it had a head and shoulders on it. We can go over that, and head and shoulders are notoriously unreliable, except when they're not. Okay, except when they actually work. And so you go into one and you think, yeah, well, this is going to be a trap, because head and shoulders are easily, the most widely recognized pattern on the planet. And therefore, if they're so recognized, it sort of diffuses their impact. Well, this one happened to work. Let me, or let's say it's working. You had a classic retest of the neckline, and now you gotten slammed. And if we retest the October lows, they better hold, because otherwise, the full downside potential derived from the top is going to be realized, and that would be around closer to 400, 405 in SPY. Okay. Let me see if I can. AD line, GDX. All right, I'm just going to take one of these. I'll take GDX, and I'll copy it, and I'll paste it, and I will put SAVA in there. Let's see. All right. Well, I must say that SAVA has some challenges. It's been in a bear phase forever. This is kind of a head and shoulders, left, center, right. The reason why I happen to notice these head and shoulders is because they pop out like, it's they just do. And most of the time they don't work. But this one, it broke the neckline, which is around 34, went to 15. And of course, you can't do a measurement from 140 to 40 of $100. 40 minus 100 is negative 60. So obviously, unless SAVA is going out of business, which is unlikely, then there's some modification you need to use that implies that there's a low coming, but where is the low and where is it most likely to go? And so if I enlarge this, these are my moving averages, right? And the moving averages are, I use 10, 17, and 50. 10 and 17 as my trading moving averages, 50 as kind of my intermediate moving average, and then the 200 as my longer term, as it were, moving average. So SAVA is trading below all of them. And this is maximum resistance near term right here, which is 16 and a half. And unless and until it gets through that and closes above 16 and a half, it is vulnerable to failing and rolling over again. And I keep thinking, when I look at this, that it's going to somewhere between 10 and 850 to end this entire bear phase that it's been in since, like July of 2021. Unless SAVA, like I'm not familiar with SAVA, but unless there's some some results from trials, PDUFA dates that are surprises that rip this thing minimum above the 50-day, which at this point is at 18. The bears are still in control of this one, but maybe there's good data coming out, and that is what whoops, and that is oh, don't do that. And then that is what SAVA looks to me. So, if you're a believer, I think you'll have a chance to buy more. I think around 10, if not slightly lower. And then you need to get above 1650 and 18 and change, and then I think you're in much better condition. Now, one more thing about a chart that looks like this, that's been in a bear phase for so long. Generally speaking, a bear phase that's been like this for a prolonged period of time needs time to base, like back here. Like this took, from December of 19 to January of 21 to base and then to take off. Now, unless there's news that rips this to the upside, some drug trial that's really positive, some phase 3 or phase 2, chances are, if there's no bullish catalyst, then this type of chart is going to have to go sideways for a while. It could be a year of trading between, I don't know, 20, or if it goes down to 10, it could be between 10 and 14 for quite a while before it takes off. So that would be my warning about a chart like that. Dell. Dell is just a pretty amazing chart, pretty amazing company. It's Michael Dell has found a way, and he's had two careers, and he's found a way. But this is a beautiful chart. This is the opposite of like a SAVA, where the price structure ripped through all the moving averages, took off. It's a beautiful thing. Based on just the pattern itself, this looks like a bull flag. You have a gap here. It gapped up. I guess this must have been earnings on September 1st. So that gap will be filled at some point. The question is Dell going to 80 before it rolls over, goes into a bear phase and fills that gap under 63, or under 63 and a half. I don't know the answer to that, but I know one thing is I would be okay. Like this is a daily chart, right? Chances are my 4-hour chart looks even better, but it's worked off a lot of its overbought condition already. So as long as Dell stays above 64, 63 and a half, this looks like a bull flag type of digestion period atop a pole, as it were, that should be a continuation pattern, or should represent a continuation pattern that does this. And that somewhere around 80, 77 to 80, that should end this entire bull leg. And then Dell will come in, probably go into a prolonged corrective phase that will take it back to the top of these peaks, which would be about 60. So we go from 80 to 60 and then consolidate, and we'll see what the world looks like at that point. So while we're at it, let's see. Let me just see if I can grab a come on. Come on. All right. Let me grab, okay, IWM. This is a 4-hour chart, right? IWM, and IWM, for all its underperformance compared to the S&P 500, it looked like earlier in the week it was going to try to take out its big resistance, right? 175 to 177. It tried gallantly Tuesday and Wednesday. And then Wednesday rolled over. Thursday, today was a disaster, and it closed at a new 5-month low, almost 6-month low today. Now, interest rates are a problem for the small cap sector, and so is the banking sector, because there's a lot of financials in this index or in this ETF. And so it has a double whammy. It has the pressure from rates. It has the divergence from the big caps, mega caps especially, and it has interest rate or banking. It has the banking sector weighing on it too. But if I take it and I paste it here again, and then I, just for argument's sake, put Dell in here, let it fill in, and then we can see, depending on, depending how long it takes to fill in. In the meantime, while it fills in, well, here we go. Okay. So here's Dell on a, this each candle. These are candles. They look like bars because I squish them together so I can get as much information in a leg, in a pattern that I can, because then I can digest it more fully. So yeah, this is just a beautiful pattern, and it reinforces what we said about the daily chart, that this looks like a high level consolidation digestion period, and that as long as this gap area actually on the 4-hour looks like it actually extends down to 61.30, which is good that we looked at it. So if that's the case, the gap starts at 61. This is what the consolidation looks like, right? And so as long as this area right here, 65.20, 64, it remains intact, this will look like a flag, pennant, whatever, and the expectation is for upside continuation. If it starts to break through here, then it'll test the bottom of the gap, I think, or I should say the top of the gap, and at 61, and then we'll see where we're at. There's a trend line here that will come into play right at the top of the gap, 61. So either it holds in here, 64, 65, or it goes to 61 area, where that would be the next place it would turn up into a new up leg. Okay. I'd like to show you a couple of things before I have to wind down, and just to give you an idea of where we're at, or where I'm at, if I'm somewhere. Where's my monthly chart? Well, I'll use my daily for now. Okay, so here's my daily chart of 10-year yield. Okay, now 10-year yield hit just about 5% today. We all know that. And the way I look at this, if I squish it so you can see where it all came from, back here in the pandemic, we hit 0.4% in yield, and now we're at 5%. The way I look at this is that from March of 2020 to October of 2021, we completed the first up leg of a new bull phase in yield. That is a bear market in bonds. Now, bonds were in a bull market. Yield was in a bear market from the time I started in this business around 1980 until 2020. My entire career up until that point, bonds were in a bear market. Bonds were in a bull market and yield was in a bear market. I think that entire paradigm has changed. I think we're in a secular bull market in yield. That means I don't think that people who are 25 years old, like I was when the secular yield bear market started, are going to wait 40 years. But I think that there are going to be reasons why this bull market continues to perpetuate itself. I don't know if it's going to be inflation. I don't know if it's going to be a premium that anybody who holds US paper is going to want premium to hold it, because any country with 35 trillion dollars of debt and adding to that debt 600 billion a month isn't getting my money unless I get a nice juicy premium to hold on to it. And it may just be that that's the psychology, that inflation is just kind of stubborn, doesn't get to 4%. Oil ratchets up to some level. We have international tensions. Who knows? But so if the first leg of this thing started at 4/10 and ended at 4% and change, we pulled back into April of 23 at 3.25, and here we are at 5. And my sense is that this leg is going to end somewhere around 5.25 to 5.30, and we're in a parabolic kind of move now. So I thought that there was a chance that Powell today would have said something that would have given the bond market reason to pause. That is, yield reason to stop going up, bonds stop going down. And for a few minutes there, it did look like it, but it didn't last because he just kept saying things. And in general, he basically said that interest rates, he doesn't expect them, he expects them to continue to need to go higher, and he's willing and able to accommodate. And, that's not what the market wanted to hear. So anyway, I wanted to show you that chart. If this is a chart, it's yield. You can't trade yield. You have to trade the bond side or the TLTs, which I follow closely as well. But this chart, if you're going to break down, there's a gap here at 470 or so, and the last pivot low is 453. So to affect a downside reversal with teeth, 10-year yield has to go back down through 450, and we're 50 basis points above it at the moment. Okay, another thing I wanted to show you where I go is my AD line. All right, so AD line is a chart. All these squiggles mean something, and they have patterns. Just so happens that in November of 21, the AD line, the NYSE AD line, peaked. The bull market in breadth peaked. First down leg into October of last year, which happened to coincide with the peak. Now remember, the S&P or NYSE, but let's use the S&P. It peaked in January of 22. The AD line peaked in November of 21, and that's classic. So when the S&P peaked, the AD line made a lower high. Then I knew this was in trouble. I didn't know how much trouble, but I knew it was in some trouble. So October of 22, all the indices bottom, start a correction. And in July of this year, all the indices and the AD line had a chance to break out. Now, this could have been a base. It could have broken out, but it didn't. It failed. And then it broke the trend line. And this looks like a wedge. So you have down, a wedge, bearish digestion, breakdown. Today, it made a new low for this move from July. So the AD line is telling us that the broad market participation is not expanding, it's contracting, and that there are basically fewer and fewer stocks that are participating rather than more stocks there were a few days last week where it looked like participation was picking up, but it doesn't look like it anymore. And it looks like even the the big kahunas like Tesla and Nvidia, which I'm going to do now, uh, are now a drag, and they're not holding up their end of the bargain. And the IWM, the small caps, look like they were chipping in, and now they've fallen apart. So, okay, Tesla. What did I do with Nvidia? Um, Come on. There it is. Okay. Okay. Nvidia is fascinating to me. All right. So this is a 4-hour chart. Goes back to the big turn at $108 exactly a year ago, October 13th, 22. That up move was actually part of a larger base, and it broke out at 200 or so, 190, 200, and just kept on going. And in here, this was the blowout earnings from May 24th of this year, just a few months ago, where basically Nvidia rewrote the expectations for chips and AI and everything else. That was an extraordinary report that recalibrated what it meant to be bullish in the sector. And they blew away everyone after this, AMD and, everyone else. Okay, so it spiked up in its August earnings. It took off in the May earnings. It spiked up in the August earnings to an intraday high at 520. Now, here's the major trend line. It comes down to the major trend line at around 410 on September 21st. And this rally was the rally that would tell us whether or not this was the first leg of a more complex correction or a completed correction followed by a new up leg. And it looked like to me that around in here, 480 or so, that was my target. 480, 482. It got to, I don't know, 476 or something. And then it started to weaken. Not only did it weaken, it broke the major trend line from last December. And now it's bearing down on all of these lows after its May 2023 earnings report. So all of these lows create support from 396 or so to around 410. So this is one critical period because we can look at all of this as a multi-month distribution top in Nvidia. In which case, all this supply is going to come out or could come out on a break. All these people are long above here, all excited. Wall Street got them all hot and lathered about how great this company was, and it can only go up. Well, a lot of them are in there above, let's call it 400. Once it breaks 400, this gap that was left behind on May 24th is one big gap from 305.40 to 366 and change. And that gap's going to get filled one day. I don't know if it's going to be next week, but right now, unless Nvidia crawls its way back above 435.80, which is what I discussed on MP Trader this morning, unless it gets above 435.80, it's vulnerable to taking out these lows, in which case I wouldn't be surprised if we saw the low 300s in Nvidia, and everybody who is really excited about it at 400 or higher is going to have a chance to buy it closer to 300, which is fine. But I'm just saying that there's some damage that could be coming for Nvidia. So I have 2 minutes left, and I am told that I should wrap it up in general before the high side of the hour arrives. So David, I will turn it back to you at this point.